Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hello, and thank you for joining our podcast. Today, Jack and I are going to discuss the rising bar for active management and why alpha generation has the potential to be much harder in the future. I hope you enjoy the discussion. All right, you wrote this interesting piece on the rising bar of active management. And one of the things that we obviously do here at Validea is we try to find managers, individuals that have proven long-term track records of success. And like you kind of said in the article, that's few and far between. But I think this can kind of create an interesting discussion how things have changed over the years with active management and how even much more difficult it is now with the proliferation of factor-based strategies and other quantitative methods. So if you want to maybe give us an intro of what you were really trying to uncover here, and then we can get into some of the specifics in the article itself.
Yeah, as an active manager, your bar you're trying to cross has always been the S&P 500, for many years. And, as I said in the article, most managers, something like 80 or 90% long-term, depending on what you look at, have failed to be able to cross that bar. So after their fees, they failed to outperform the S&P 500. So for a very long time, that was your goal, as an active manager, was to beat the S&P 500. But one of the things that academic research has shown is there were ways you could do that using factors. And so, for instance, if you had a value tilt to your portfolio, or if you bought value stocks, and you held them through the ups and downs, you could beat the S&P 500 over the long term. If you used momentum, you could beat the S&P 500 over the long term. So these were factors, that have been discovered by academics that allow you to basically generate an excess return over the S&P 500. And so what I'm talking about in the article is the fact that those factors have now been discovered and those factors are now widely available. Well, that raises the bar for anybody in the active management industry. So, for instance, now if I want to use a simple exposure to value, I can go find something from BlackRock, something from Vanguard that gets me that exposure for maybe, say, 10 basis points. Mm-hmm. So now as an active manager, just buying cheap stocks and using a simple exposure to value is not going to work for me anymore, because I'm not going to be able to justify, my 1% fee or my 80 basis point fee or whatever it is, based on doing something that, you can now get from Vanguard for 10 basis points. And so that's what I was getting at in the article is, now it's more difficult to be an active manager, because not only do you have to beat the S&P 500, but you have to beat these factors that have been discovered and are now widely available and cheap.
Yeah, I mean, that's a good point. I don't know if a lot of investors really benchmark to those yet. I mean, they're really still looking at the S&P. So I think that the S&P has been a very hard index to beat over the last 10 years. And we know value has underperformed. But, I think that you're right that a lot of these factor strategies now can be bought for a lot cheaper than they could maybe even 10 years ago. And that creates a whole new set of hurdles, I think, for active managers.
Yeah, and and I think you're right about, I think, having a separate money management business ourselves, I mean, everybody benchmarks to the S&P these days, just like they always have. They want to see how you're doing against the S&P. But the point I was making is, if you're generating an excess return over the S&P and you're doing it just by picking simple value stocks, a diversified basket of simple value stocks, well, you're not adding value relative to what's easily available out there. Mm-hmm. And, maybe at the end of the day, for a period of time, you can do that. But eventually, people understand that, I can get this simple value exposure from Vanguard. I can get it from BlackRock. So as an active manager, you have to do something beyond that now. You have to, add some more value in some other way. That could be adding things to your factor strategy that, are not widely available, or it could be something else. But you just have to do something to sort of exceed value as a whole.
Right.
And actually, value is not the greatest example right now, because obviously value has been struggling. So
well, yeah,
if you're
but
investing in value, you're underperforming the S&P 500 anyway.
Yeah, in the article, like you gave the example of the this iShares Edge MSC USA Momentum Factor ETF, which has crushed the market basically over the last, since 2013. And, that charges like 15 basis points. So here's a good example of something that has, dramatically outperformed the S&P. It's basically using a proven factor like momentum, and you're getting it for, pennies on the dollar, basically.
Right, that was a good example in the article because if you are a momentum manager, if that chart was not the iShares momentum, index, if that chart was actually an active manager using momentum and you looked at that chart against the S&P 500, you'd say this guy has got a lot of skill. But, that fund is available for 15 basis points. And so, if you produce those returns and you charge 70 or 80 basis points, well, you really haven't added any value relative to momentum as a whole. And that's what I was getting at in the article is, in the past, that type of outperformance, where there weren't factor funds widely available, that type of outperformance, was alpha. That type of outperformance would have attracted a lot of capital. Today it's a different story. The bar is higher than it used to be.
Well, and that brings up and goes into that AQR Superstar Investor study that you and I, and a report that you and I have actually talked about quite extensively, and that was the topic of a recent conversation on Twitter. And basically, what that report is doing, and AQR was the firm that did the research behind it, is they looked at the performance of some of these great investors. So Buffett, Lynch, Bill Gross, and George Soros. And then what they tried to do is they looked at their returns and then they broke out how much of their returns were due to value, or how much were due to low volatility, or how much were due to some degree of leverage. And what they sort of showed is that everyone except for Lynch, you could get most of that return through exposure to some type of factor, whether it be value, low volatility, or size, or whatever it was. So they were like trying to, break out the returns of someone like Buffett and say how much of it has come from, exposure to certain factors. We know that the devil's in the details. It's not that easy. That's another thing that you and I have talked about. Maybe we'll talk about it here, but it is to your point that, a lot of these great investors, their performance can be tied back to having some type of factor exposure.
That's right. And, if you look at other successful, let's use value as an example. You look at other successful value investors, you'll find the same thing. If you go back 30 years and look at their track record, a lot of their track record was just the value factor in general. But also, and this is sort of what came up in the debate on Twitter, that's not fair to those investors. And the reason it's not fair is because if I go back 30 years, I couldn't get 15 basis point exposure, widely available exposure to value. So back then, doing the same thing was alpha because there was no other way to get that exposure inexpensively. Now it's not, because now I can get that value exposure inexpensively. And so it's not fair, and AQR mentioned this in the paper, by the way, it's not fair to go back and say, I'm going to take away from Buffett's track record because I can use these simple factor exposures, because there was no way to get those simple factor exposures inexpensively back then. But now there is. And so now the bar for somebody today is a lot higher than it was for somebody like Buffett.
So let me ask you this. If those factor exposures are so easy to invest in now, I mean, is there a chance they may not work? I mean, it kind of makes sense. They maybe worked in the past because they weren't really easy to get, to get that exposure. But now we're basically saying it's super easy to get momentum. It's super easy to get value. So, does it make sense that those factors are still going to produce the premium in the future that they've produced in the past? I mean, what are your thoughts on that?
I mean, I think it makes an argument definitely for reduced premium. I do think they're still going to work. And I think there's reasons, behavioral and risk-based reasons why they're going to continue to work. But I do think it makes an argument that, now that these are widely known, you may not see, if you look at a factor like value and maybe you saw a 3 to 5% excess return historically, you may see a 2 or 3% excess return. Now. So I do think it makes a case for, maybe they'll be less effective than they were in the past, but I do think they're still going to work. And, also it's important to understand part of the reason these factors work is because you can go through really long periods where they don't. And so, if you're sitting as a value investor right now, you understand exactly what that means. We've gone through a huge period where value is underperformed. And so part of it, of why these factor works is the pain of going through that period. And, many investors are going to bail on the strategies during that period. And, that's in part what allows them to continue working.
Yeah. Yeah. And I think we, the way that we express these factors is through the strategies of great investors that we run quantitatively and other strategies that have been proven over time. And this is something we talked about on a recent podcast, but, we're not buying the broader market with our investing system. We tend to be much more concentrated with our portfolios. So I think with that comes more risk, and with that comes more, potential, I think, for outperformance over time. But it doesn't always translate into that. But there's a different spectrum of how you can express these factors in a portfolio. And I think what your article is mostly talking about is these, smart beta type of investment strategies versus, highly concentrated strategies or portfolios that give you, ultra deep value exposure or exposures, not just value momentum, whatever it might be.
That's right, and that's one way an active manager, and you see some out there that do this. That's one way an active manager can add value above and beyond, say, the 10 basis point Vanguard Value Fund is. Concentration gets you more exposure to the value factor. It gets you a rougher ride, but it gets you more exposure to the value factor, and so more exposure to the value factor gets you more excess return, at least if history is any guide. And so that's one way you can do it. Another way you can do it is you can find criteria to couple with the value criteria. You can find your own strategy that enhances the returns of the value factor over time, or momentum, or whatever it is you're doing. So there's definitely ways to do it. The point of the article was it's just more difficult than it was before. And, this is also something that, we may look back. So for instance, let's say you and I discover a factor today. I mean, that's not very likely to happen, but let's say you and I are the smartest guys out there, and
it's called the Jack and Justin factor.
Yeah, exactly. Let's say we discover that factor today. Let's say we're able to use that factor for the next 10 years. Where nobody else figures it out. We're able to use it and produce excess return over the next 10 years. That is alpha. We've been able to find something that nobody else has, and we've been able to use it for an extended period. Now, let's say 10 years from now, somebody figures out our factor. It becomes widely available, an academic paper comes out. Well, now using that factor going forward, if that becomes widely available and cheap, for people to access, it no longer is alpha. And that was sort of the point of the paper is, anything that's widely available and inexpensive for investors to access that produces excess return eventually does not become alpha anymore. It becomes something that becomes commoditized, and then it's the job of managers to find something else and find something to justify the fee that they're charging.
Right. But like you said, it's what happens is these things stop working, and then you get investors fleeing those things. And ultimately, I think that's a big part of why a factor may continue to work. So that's just an interesting, but I think your point is a good one, and it's an interesting thing to think about, that these factors they have been commoditized, and you can basically almost get them for free at this point. There's two other things I just wanted to ask you since we're on this topic. We're going to pivot a little bit, but you mentioned this in the beginning of your article, which is, and I think it's a concept worth discussing, and a lot of investors know this, but that when you take the aggregate, all of the managers in the market, how collectively they can't beat the market because of fees. And I just think that's that's something that a lot of investors know, but it doesn't really get discussed a lot. And I think it might have been Bill Sharp who was the one that developed this concept. I don't know the exact name of it, but that, all the active managers in the market, they have to underperform the market because they are the market, and then their fees are netted out. So is that something you just want to explain that a little bit? I think it's worth talking about.
Sure. So if you look at, let's assume the market is 50% index-based investments and 50% active managers. So we know the total of that as a whole is the market. So we know the sum of the index plus the active managers has to be the market because that's all that's available. So if the index is the market and the whole is the market, then what's left, active managers as a whole, also has to be the market. It's a simple math thing.
Right.
And so that is gross of fees. So what that means is if active managers are the market gross of fees, then net of fees, active managers by definition have to underperform the market by the amount of their fees. Mm-hmm. So in aggregate, asset managers will always underperform the market by the amount of their fees. But within that, there will obviously be some people who outperform the market. There'll be some people that underperform the market. So it's not an indictment that asset management can't work. It's an indictment of asset management as a whole has to underperform by the amount of its fees.
And I think the evidence shows that more and more managers are underperforming the market after fees over time. So it's the market's become harder to beat, potentially due to some of the things we're discussing today. There's more competition in the market than there was maybe 20 or 30 years ago. This is a point that Michael Mauboussin, who you've interviewed for your 5 questions column on Validea, has written about and discussed. And one of the interesting things with what he has brought up, and some of the evidence in terms of the number, how much it's declined in terms of the percentage of active managers being able to beat the market over the years is pretty mind-blowing. But, one of the points that is, at first I thought it was going to be the opposite way, but he's basically said that, as more and more, it becomes harder and harder to beat the market, it means that, there's some of these managers will just go away. They won't survive. But the ones that do survive will be the ones that are able to beat the market. So even though you think on the surface, like managers going out of business or shutting funds down or shutting strategies down would be less competition, it actually is kind of flipped upside down in the sense that only those managers that are able to produce long-term alpha are the ones that are going to survive. So that's just another interesting sort of thing to think about. It's a dynamic that's going on in the industry. And, Maubussin's written a couple of different things on that. I don't know if you have any other opinions or feelings on that or anything, but.
Yeah, no, that's definitely true. Another thing Maubussin's written about as well is, the balance between the alpha that's available in fees. And so you mentioned it's getting harder to beat the market, but one of the other things that's happening is fees are compressing down. And so at some point, there'll probably be an equilibrium that gets reached there, where the value that active managers are adding gets closer to the fees that they're charging. And so as less people can beat the market, if fees keep falling, you're working your way towards an equilibrium where your active management will settle in, but settle in at a much lower price than it has been historically. And then you're seeing that process play out.
Mm-hmm. Lots of interesting stuff. So yeah, I think that's good. What we'll do is we'll put a link to the article in the show notes, and hopefully you found this discussion interesting and insightful. And we'll see you next time. So thank you.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.